This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. With growth stocks selling off, I'm getting a lot of questions, mostly on Twitter, about whether those growth stocks are now values. Remember, there is classic values, and that's determined by price to earnings, price to sales, price to book, or PEG ratios. And then there's value compared to the peers or industries. We've used both kind of ways to determine value over the last several years. Now, the one that compares it to peers or industry, that would be like Meta Platforms, formerly known as Facebook. It's trading at 21.6 times. So that sounds high, right? To a regular value investor, you'd be like, I'm not looking at any companies trading at 21 times earnings. But compared to the Fangman stocks, which is what I consider to be its peers, it's lumped in with all of those, the Apples, Netflix, Nvidias, Microsoft, Amazons, and Alphabet. It looks pretty cheap at 21 times. That's the cheapest of the PEs among the Fangman stocks. And even historically for Meta, that PE of 21 times is at the lower end for the company. I think when it was having those PR issues about privacy and stuff a couple of years ago, it might have briefly hit or fallen just a little bit under 20 times. I know we were talking about it on the podcast back then because it looked cheap then as well. But otherwise, it's traded a little higher than this in the 21, area historically. So in that way, if you're looking for value, Meta Platforms, ticker FB, might be a value here compared to its peers. So you can find some value looking at the growth stocks if you use that method. But many of you have been asking me about stocks with the sky-high valuations, which have simply fallen sharply. So I wanted to take a look at a random 5 stocks that I just picked because I knew that they had fallen and that they were expensive previously. And these are some of the ones that you all have been asking me about. Like, aren't these values now that they've plunged? So let's look at some examples. So the first one is Shopify. Who didn't want to buy Shopify in the last couple of years, right? We all kind of kicked ourselves like, why didn't I buy that? And then it kind of ran away to new all-time highs and valuations were sky high. So true value investors, we had to stay out of that one. But over the last 6 months, the shares are now down 45%. And year to date, they're down 35% in this sell-off. So Shopify, ticker SHOP, of course, I took a look at its PE. It's at 128 times. Obviously not cheap on a PE basis. But everybody tells me, no, Tracy, don't look at PE. You have to look at price to sales with these growth stocks. So I took a look at that, 26 times. No, that's not cheap either. Now, I wasn't expecting to get a price to sales under 1 by any means, which is an indication of value if it's under 1. But here, I'm literally paying 26 times the dollar of sales that Shopify is generating. So that's a little too expensive for my blood. So a stock like Shopify, even though it's plunged as much as it has, is still not a value here, not even compared to its peers. So something like this, I'm a no-go on it, and I'm still on the sidelines. Then I took a look at PayPal. This was another one that many of us lamented, why didn't I buy that several years ago? It's been featured on my Market Edge podcast many times since it was spun off from eBay in 2015. So there were plenty of buying opportunities in there when the valuations weren't sky high. Then the shares have soared during the pandemic. But over the last 6 months, they're now down 48%. And year to date, down another 16 just for this year. So what does the valuations look like on PayPal, ticker PYPL? PE is now at 30.7. And the price to sales has come down to 7.5. So still pricey, but not insane like Shopify. So PayPal's a little more interesting to me. It's getting a little bit more into the wheelhouse for those of us who are value investors because it still does have growth. So it is going to trade at a little bit higher premium than a pure play value stock. So PayPal is going to go on my watch list of possible additions, maybe, especially if it comes down even further here. Okay, then let's look at Snowflake, ticker SNOW. So over the last 6 months, I was surprised that this one was down only 0.5%. So it's basically done a round trip over the last 6 months. So it did spike higher in that period and has fallen back down, but we're now basically back to where it was 6 months ago because year to date, the shares are down 22%. So we're still on the downward slide here on Snowflake. So it doesn't have a PE because it has negative earnings. So immediately as a value investor in these types of market conditions, I don't like that. I want earnings when the Fed is raising interest rates. So I'm immediately not liking it. Price to sales though, because that's what everyone tells me to look at. If there's no earnings, look at those price to sales ratios. And this one, it is at 78.6. So for every dollar earned, I'm paying 78 times what that is. See, as I laugh, it sounds absurd, right? But when growth stocks are in a bull and we have high GDP and the Fed is stimulating and Congress is doing, stimulate, infrastructure and all this kind of backstopping of the economy and the job market is good, then these growth stocks don't seem so absurd at 78 times price to sales ratios. And I'm not saying a lot of that has changed. The economy still is good. Employment is still down. GDP is still looking good for the next several quarters. But the Fed is now going to be tightening and raising rates. So it's a different scenario. I'm not liking Snowflake here, and I would not be adding this one to my watch list. Okay, let's look at CrowdStrike, cybersecurity side of things. This was a hot area. Ticker CRWD. There's only so many stocks that you can buy in cybersecurity right now that are publicly traded, obviously, so many companies. And this one has earnings, but the shares have plunged. So how bad? Over the last 6 months, now down 41%. And year to date, down 22.5. So pretty severe sell-off for CrowdStrike. PE now, these are forward PEs, 271. But again, I've been told I have to look to the price to sales ratio, not the PE. Price to sales ratio, 28.3. So both of those metrics on valuation are sky high. And again, with the change in what the market conditions are like, this is just not one that I'm interested in. And I don't consider it to be on sale here, even though it's down 41% in the last 6 months. So I wanted to look at a retailer as well, because a lot of those soared and now have come back down to earth as well. So I picked the red hot Lululemon, ticker LULU. I own it in my own personal portfolio, but I did buy it several years ago. So it was cheaper. I had Maddie Johnson here at Zacks on the Market Edge podcast around Black Friday last year. And we were talking about Lulu. And I think we mentioned it was trading around like 49 times on its PE. Now the shares have come down. So over the last 6 months, shares are down 23%. Year to date, however, the selling has picked up on the sell-off and it's down 21%. So that's a big correction on Lulu. We haven't seen one of these in a while. And it has pulled the PE down a bit. So it's now trading at 40 times on the forward PE. Price to sales is 6.8. So some of these retailers that have been red hot with double-digit comps, double-digit revenue growth, big gains in their online business during the pandemic, and strong brands, top brands like Lululemon. Some of these are always going to trade at a more expensive valuation unless you get some kind of event, like the yoga pant issue that happened with Lululemon a number of years ago, or like a Chipotle where they had the PR issues there and the shares plunged. And then you had like a buying opportunity where the valuations just weren't as high. But for these kinds of strong brands, investors are usually willing to pay a higher price point for them. So while these shares have come down from more obscene 49 times to 40 times, they could go a bit lower here. And then I might be interested again in adding to my own position. But here, still at 40 times, still pretty pricey. And there's a lot of question marks in the retail area for 2022. So keep that in mind when you're looking at the retailers. So also keep in mind, trends have changed. The momentum has ended for a lot of these growth stocks. But we as investors still tend to think that what was happening before is going to happen in the future. So we kind of stay on the trend even when it has changed. So my advice really for value investors is don't chase the last trend. The Fed has changed course. It's tightening. Rates are going to rise. So don't chase it. And most importantly, don't chase it because most of those growth stocks really aren't values here. In these kinds of big sell-offs, we do get a lot of follow through of selling off of even value stocks. So I don't know about you, but I've been following a lot of the value stocks that I've been interested in and that we've even talked about here on the podcast already here in 2022. So while LULU still remains expensive at 40 times, what about CROX, ticker CROX? I talked about CROX in the podcast episode I did earlier this year on the secret weapon of the PEG ratio. And it was cheap then. So that was just like a week or two ago. And back then, back way far, 7 days ago, it was trading at 12.8 times and it had a PEG ratio of 0.85. But the shares have sold off in the sell-off. People are abandoning CROX, even though it was already cheap. So year to date now, these shares are down 19.2%. And I'm reporting this on January 26, 2022. So we haven't even gone through a full month yet. And the shares are down basically in a bear correction on CROX here, down 19.2%. The PE has now fallen to 10. So even cheaper. And the PEG as well has fallen to 0.67. So it was at 0.85, it's at 0.67. All the metrics have gotten cheaper. So these earnings from CROX are now on sale. They were already cheap, but now they're even cheaper. So why should I want to buy some growth stock like Shopify that, has fallen, but it's still expensive on a fundamental basis when I can get true value stocks, buy a classic value metrics that are now even cheaper. So now is really the time for value investors to get true value stocks on sale. It's common after a big bull market in an asset class, like we've just seen in the tech stocks, the growthy names. For us investors, we want to continue to focus on that. Even if that bull has taken a break, it's pausing, or maybe even ending. It's just the way investing works. If your trade has worked for 5, 10, 15, 20 years, why would it not continue to work, right? So that's the momentum. Momentum sticks around a long time until it doesn't. So meanwhile, there are other bulls that have already started on stocks that are also usually cheap. You know what those are because I've been talking about it for several months now. So energy, banks, some of the retailers, not LULU, but CROX, obviously, and agriculture have all started what should be some good bull markets here. So many of the banks have already reported earnings because they report early in the earnings season, and a lot of them have actually sold off on those earnings reports just because of market weakness and otherwise just worries or whatnot. So some of them are off their recent highs this month. They're not down 20 or 30% usually. I didn't look at all of them, obviously. And it does matter if you're looking at the big international banks, the ones that do trading, the regional powerhouses, or your local community bank. But not many of the community banks with the Fed about to raise are going to be down 20 or 30% from their recent highs. But some have pulled back 5% to 10%. So it's easy to accumulate these if they have these like little mini pullbacks. And if you're already in the stock, I encourage dollar cost averaging in some of these because while it's not, a huge pullback like we've seen in the growth stocks, you're still getting it on sale. I'll take a 5% sale, right? And the earnings are going in the right direction, and these stocks have cheap classic fundamentals. So look for value in the bulls. I know there is the lure of the glamour stocks, like I just said. The growth stocks have been such great performers. It's hard to change course. That's why you're all, tweeting me these questions like, oh, isn't Shopify a deal here? Because we're still living in the world of the growth stock trend and the growth stock momentum. So look for some value outside of that. And on the big caps, like the Metas, there will be more favorable fundamentals for those companies. They're making billions of dollars for the most part. Most of them, if not all of them, have earnings. And a lot of them pay dividends or doing share buybacks. So we still, in a strong economy, will look to the Fangman stocks for leadership. And you could still get some of those cheap, as I was mentioning earlier in the episode with Meta Platforms. But a couple of the others have had nice double-digit pullbacks here. So take a look. Some of those may also have historically low or close to historically low forward PEs as well. So don't live in the past. There's too many bulls in actual value stocks right now. And with these market conditions changing, I can really see a strong year here in 2022 for real value stocks. And you are getting a bargain on those earnings, on the sales. And a lot of these, they may not have a price to sales under 1, but it's going to be pretty low if you're looking at a true value stock. So look around in true value and stay away from those growthy names that look like values, are still expensive, and could be value traps if their earnings start to slide here in 2022. So let me recap the tickers I mentioned. So I did talk about Meta. I own it in my own personal portfolio. I did buy many years ago when it was kind of out of favor. I didn't get it at the IPO, and I didn't get it on the all-time lows that it dipped to under the IPO. I was dollar cost averaging. I think my average is around $90. I stopped buying years ago, but I still own it. And so I consider it to be kind of cheap. I have been watching it. It is on my watch list because of its recent weakness and that the PE has come down. So Meta still has the FB ticker, but we'll see if they get to change that soon enough. So I mentioned Facebook, Meta, FB. Then we talked about Shopify, SHOP. It's come down a lot, still really expensive. PayPal, a little more interesting to me, PYPL. I'm putting this one on my watch list too. Not quite cheap yet. I get a little greedy when these stocks go on sale and have good fundamentals. So I'd like to get it a little cheaper if I can. I may not. It may rebound here off of its earnings report, if nothing else, but we will see, and I'm willing to be patient. So that's PayPal, PYPL. Snowflake, SNOW, with that price to sales of 78. CrowdStrike, CRWD, price to sales of 28. Lululemon, ticker LULU. I do own it, bought several years ago. Price to sales 6.8, but still got that forward P of 40. Still a little too pricey for me. It's not on my watch list. I do own it, but I have a lower basis, so I'm just hanging out in it. So we will see. Then I did talk about CROX again. Seems to be my favorite stock again here in 2022. I do not own it, but I'm thinking about it, right? On this big pullback it's had here in 2022. Shares at just 10 times, ticker CROX. X is an X-ray. It's not CROX, CROC. It's CROX. And remember, shoes are always popular coming out of difficult economic conditions because they're cheaper to buy. You can get a whole new look with your wardrobe and your appearance by buying some shoes. So I'm liking a lot of the shoe makers and retailers here, but CROX is the one that is really cheap here. So CROX is that ticker. And as always, I am going to be bringing you the value stocks every week, and there are plenty of others. And we're going to have some good shows coming up once we get some more earnings in about some of these cheap industries, energy, the banks, and agriculture. So you want to be sure to subscribe. Get us on Apple Podcasts, get us on Spotify, get us on Amazon Music, get us anywhere that you can get the podcast. We will be there as the Value Investor Podcast. And I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.